The SCHD ETF is not having the performance that it once has had over the past 5 years or so. The ETF is doing so bad that it's still in the red year to date as far as price return, trailing the S&P 500 by well over 10%. Now, of course, this is not the performance that dividend growth investors like myself expect from this ETF, and this has investors questioning the future for SCHD and demanding answers now. Now, in this video, we're going to do a deep dive into exactly what has happened to SCHD over the last year and figure out exactly why this ETF has been performing so terribly. Now stick around because we have a lot to go through. Ready for you, please drop a like in this video and subscribe for more future content like this. Now, quick background on SCHD, it's the Charles Schwab US Dividend Equity ETF. It's a really popular dividend growth ETF that's performed well historically speaking, with a cheap expense ratio of just 0.06% and an objective of tracking as closely as possible before fees and expenses the total return Dow Jones US Dividend 100 Index. This ETF has a lot to offer. And looking at SCHD's performance on the max time frame, this ETF has performed very well historically, with just price return alone being up over 185.58%. And this is not dividends included. Investors are questioning why in the world has SCHD performed so bad this year. Now, partially the reason why SCHD has performed so bad is because of the most recent March 2023 index reconstitution. Now, the Schwab US Dividend Equity ETF's index underwent its annual reconstitution as of this past March 2023. And a total of 25 companies were added, names like abbvie and Chevron, while IBM was the most prominent deletion. Now, because SCHD does track the Dow Jones 100 Index, I think it's pretty important to look a little bit deeper into the Dow Jones Dividend Indices methodology and see exactly how this works, how stocks are added or maybe not added. And to be honest, for anyone holding on to SCHD, I think it's very important to know some of these facts if you are going to hold on to this ETF long term. So the methodology says Dow Jones US Dividend 100 Index universe. The index universe is defined as the constituents of the Dow Jones US Broad Stock Market Index, excluding REITs. So even though REITs are great, I'm a huge fan of REITs, they are not going to be included into this index. It then says stocks must pass the following screens: minimum 10 consecutive years of dividend payments, minimum FMC of US 500 million, minimum 3-month addVT of $2 million US. Stocks passing all 3 screens are ranked in descending order by IAD yield, defined as the stock's IAD, not including any special dividends, divided by its price. The top half of securities based on its rankings are eligible for stock selection. The reference date for dividend payments history is the last business day of December, while FMC and addVT are as of the last business day of February. Now, the index construction, also very important. Constituent selection is as follows. The eligible securities are ranked by each of 4 fundamental base characteristics. Things like free cash flow to total debt, annual net cash flow from operating activities divided by total debt. Companies with 0 total debt are ranked first. Then return on equity, annual net income divided by total shareholder equity. Then IAD yield, and then 5-year dividend growth rate, defined as this equation below. It then says the 4 rankings are equal weighted to create a composite score, and the eligible securities are ranked based on the composite score. The top 100 ranked stocks by the composite scores are selected to the index, subject to the following buffer rules that favor current constituents during the annual review, which are the constituent stocks will remain in the index as long as they are among the top 200 rankings by the composite scores. So even if a stock doesn't rank as high, as long as it's already in the index, it could still stay. Non-constituent stocks are added to the index based on their rankings until the constituent count reaches 100. If 2 non-constituents have the same composite score, the non-constituent with the higher dividend yield will be selected. And then as far as the weighting goes, it's pretty simple. It says stocks in the index are weighted quarterly, based on a capped FMC weighted approach. No single stock can represent more than 4% of the index, and no single global industry classification standard sector can represent more than 25% of the index, as measured at the time of index construction, annual rebalancing, and quarterly updates. So now that we briefly went through the SCHD reconstitution and of course also looked into some of the methodology of how stocks are actually added and taken away from SCHD, looking a little bit deeper into the holdings of this fund, this is the true culprit of why the ETF has been performing so bad. So since the most recent reconstitution, SCHD's top 10 holdings are things like Amgen, Cisco, Broadcom, abbvie, the Home Depot, Merck, Coca-Cola, Pepsi, Chevron, and UPS. Now to look into the top holding of SCHD as of right now, Amgen, ticker symbol AMGN. This stock year to date is down 1.05%. Now on the max time frame, this stock, Amgen, has done very, very well, up over 5,226% as far as price return over the last 29-30 years. But once again, zooming back in, looking at how the top holding of SCHD has performed year to date, this stock has performed quite poorly. Here's another example of another one of the newer stocks within the ETF. Now, abbvie on the max time frame has also performed very, very well, up over 345% plus on the max time frame, not dividends included. But year to date, this stock is down almost 10%, which is of course once again dragging SCHD down with it. Another stock that makes up SCHD's top 10 holdings, UPS, down 2.25% year to date. So now we went through just a few of the top 10 holdings of SCHD, and it kind of paints a picture on why this ETF is probably performing the way it has been over the last year. Also important to note, looking into the top sectors, things like industrials, healthcare, and financials. Financials almost making up 15% of the overall ETF. And of course, it doesn't take a genius to realize that the financial sector hasn't performed all that well year to date, considering there's even been massive bank collapses, etc. So the SCHD shareholders, including myself, are definitely curious on whether or not these top 10 holdings, and of course the rest of the stocks within this ETF, are going to be able to turn a corner and perform decent throughout the second half of this year. Another very important aspect to look into when it comes to the Schwab US Dividend Equity ETF is of course none other than the dividend. Now the last dividend that was paid from SCHD was 66 cents per share. And with another dividend payout coming within the next month, in my personal opinion, depending on what that dividend is, it's going to put a lot of faith or even a lot more pressure on SCHD. And this is of course because SCHD is known for the massive dividend growth rate. Over the last 10 years, SCHD has an impressive dividend growth rate of around 11.3%. The last 5 years, 13.9%. The last 3 years, 12.3%. But the trailing 12-month dividend growth rate is only 7.13%. Now, if the future dividend paid from SCHD does move up higher than the previous September dividend of 64 cents per share, I do think that it might instill some more faith in this ETF for long-term holders, reminding them that even if the overall price appreciation isn't there for the ETF, the dividends are still growing up and to the right. So in closing, what are my current thoughts on this ETF and SCHD as a whole? Now, I've been personally buying up a ton more shares of SCHD over the last year in the low 70s, stacking up so many shares to the point that now I'm holding around 350 shares throughout my portfolios. Now, for me personally, I'm going to continue to buy shares of SCHD unless something massive was to change for the ETF. And this is simply because the ETF has shown great ETF price appreciation over time. The ETF stock picking methodology has worked so far for the most part since the fund's inception. And of course, with a massive amount of dividend growth, I'm excited to be paid more and more cash flow over time from holding on to my shares of SCHD long into the future. But I want to hear from you guys down below when it comes to one of the most popular dividend growth ETFs, SCHD. Are you personally still buying shares of this ETF, or are you staying away from it from here? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.